Hello students, today I am going to talk about the marginal costing. This is topic covered in cost and control accounting MCOM second year. What is the meaning of marginal cost accounting? What is the topics we are going to cover in marginal costing, that I am going to explain. So, here marginal costing is a variable cost. So, meaning of marginal costing, when the additional cost incurred for the increase of one additional output, so that is called as a marginal costing. Simply we can say that the change of cost because of the change of output units. So, that is called as a marginal costing. Marginal costing as the amount at a given value of output by which aggregate cost are changed. If the volume of output change, the cost also going to be changed. So, that is called as a marginal costing. And key features of marginal costing. Simply marginal cost, we can tell that it is a variable cost and it is separated from the fixed cost, and here we are going to use this marginal costing to analysis of break even analysis and profit planning, and to calculate the contribution also we are going to use the marginal costing. What is the advantages of marginal costing? So, marginal costing will help to take the decision making, and it is very effective tool for the profit planning, and it is facilitate to the controlling of the cost, either it is variable cost and fixed cost, and also it is provide for the best technique for the break even analysis of the for the management purpose. What is the limitations of marginal costing? So, marginal costings, there is a limitations. Here we are going to consider only semi variable cost. That semi variable cost includes that variable cost and fixed cost. So, it is very difficult to segregate sometimes, and it is excluded fixed cost in case of decision making, and it is failed to reflect the impact of increased the fixed cost due to the development of the technology and products. So, here variable cost cannot be successful applied in the cost plus contract method. So, these are the techniques of the limitations of marginal cost. So, what is the importance of the marginal cost? So, marginal costing is very important to analyze the CVP analysis. At the same time, when you are calculating the components of the CVP analysis like contribution, profit volume ratio and break even analysis and margin of safety, to calculate this all the components of CVP, this marginal costing is we are going to use. So, some of the important in managerial decision making purpose. Now, this is the first important point is profit planning. So, when you were calculating the profit or when you are going to estimate the profit for future, we are going to use this marginal technique. To profit planning, we are going to take the very important factor of the marginal costing. Next one is the product mix decision. Product mix decision means what? So, when you are producing more than one product, which product is giving the more contribution, which product is giving the high profit. So, that is very important. So, when you are producing the more than one product or more than two products, so least contribution product we are going to eliminate. So, here it is very helpful to decision making purpose of product mixing time. Next one is the make or buy decision. See, when any component, whether you want to prepare yourself or when you want to make your factory, and at the same time whether you want to purchase outside, to take the purchasing decision from the outside or whether you want to make yourself in your factory. So, this marginal costing technique is very important and it is going to influence to take the decision also. Simply here marginal costing, we are going to take the variable cost, we are going to ignore the fixed cost, and we are going to compare outside price, outsourcing price, and what is the variable cost incurred if you make that product. So, the difference based on the different you are going to take the decision. So, this marginal technique is the very important also for the purpose of make or buy decision. Shut down or a product or plant. So, if any plant is not producing anything, when there is a profit is 0 and when we are not able to cover the fixed cost, whether the plant or product continue or shut down, to make a decision, this marginal costing technique we are going to use. So, it is very help to take the decision whether shut down the plant or whether continue the producing of that particular product, we are going to use the marginal costing technique. And selection of the production method. So, which method we are going to follow that? Cost effective different production techniques. So, we are going to use the which method is suitable and which method is not suitable to take the decision, this marginal costing we are going to use. Next one is the cost value profit analysis. So, it is also called as a CVP analysis. CVP analysis talks about the relationship between the sales, volume of the sales, profit and different costs. It is included either variable cost or fixed cost. So, here to maximize the profit, we are going to calculate the association and technique of these variables. So, this method also studying the relationship between the cost, volume, production, sales and their impact of the profits. So, this is also called as a cost volume profit analysis. So, this cost volume profit analysis, what is the main objectives? See, this cost CVP analysis will help to forecast the profit fairly and accurately, first purpose. So, with the help of this CVP analysis, we are going to forecast the profit. With whatever we are going to forecast, that result also it is very accurately we are going to receive. Second one is that it can act effectively to profit planning. So, to calculation of desired profit and to calculation of forecasting future profit. So, this CVP analysis we are going to use, and also it helps the ascertaining the break even point and setting up the flexible budget. So, it is also help to calculation of the break even sales. So, this CVP analysis we are going to use the break even analysis. So, what are the elements are included in the CVP analysis? Generally, when you are going to calculate that, when you are going to analyze the CVP analysis, we are going to use the marginal costing equation, first one, and we are going to calculate the contribution, we are going to calculate profit volume ratio, that is nothing but a PV ratio, and break even point and margin of safety. Let us, I am going to explain one by one. So, marginal costing equation will help to find out that contribution, profit volume ratio and break even point and margin of safety. What is the contribution? So, contribution means what? So, this is the marginal costing equation. Marginal costing equation, sales minus variable cost is equal to fixed cost plus profit. And contribution. Contribution means what? What is the meaning of contribution? So, contribution is a difference between sales minus variable cost. So, here this contribution can contribute fixed cost and profit. So, when you deduct variable cost from the sales, so that is called as a contribution. Contribution includes fixed cost and profit, and contribution also known as a gross margin. So, it is also renamed, that is gross margin. So, contribution can be represented as, and we can calculate it the following methods. So, when you want to calculate the contribution, that is we are going to take the sales, and from the sales we are going to deduct the variable cost, or when you are having the two variables of fixed cost and profit, the aggregate of fixed cost plus profit also called as a contribution. And contribution also we divided into two parts, fixed cost and profit. If they given any one component, if they given contribution, remaining another component also we are going to find out, and simply with the help of that marginal costing equation we are going to calculate the contribution, that is nothing but a sales minus variable cost is equal to fixed cost plus profit. I will give the one example relating to the finding of the profit from the help of marginal costing equation. From the following information, find out the amount of profit earned during the year using the marginal costing equation. So, from this problem they given fixed cost 5 lakhs and variable cost 10 rupees per unit and selling price 15 rupees per unit and total output they given 1,50,000 unit. So, here the contribution we can find out with the help unit wise, at the same time the total amount wise also. If you want to calculate unit wise, simply you can take selling price and variable cost per unit. Selling price per unit and variable cost price unit. Selling price already they given 15 rupees and variable cost also they given 10 rupees. So, 15 rupees minus 10 rupees, you will get the 5 rupees. So, that 5 rupees is called as a 5 rupees per unit, and here we have to calculate the profit. So, first before calculation of the profit, we need to calculate the contribution. So, the contribution with the help of that marginal costing equation we are going to calculate. So, contribution is equal to sales minus variable cost or marginal cost, as before I said. So, now I will take 1,50,000 units into 15 rupees per unit minus same units 1,50,000 units into 10 rupees of the variable cost per unit. Total sales are 22,50,000 minus 15 lakhs of the variable cost. So, remaining difference amount, that is 7,50,000 is called as a contribution. So, when you know the contribution already I said that before only, contribution includes that fixed cost and profit. So, these 7,50,000 includes fixed cost as well as profit. To calculation of that profit, simply contribution minus fixed cost, you will get the profit. That is 7,50,000 is the contribution, already fixed cost they given in the problem, that is 5 lakhs. 7,50,000 minus 5 lakhs, remaining 2,50,000 is called as a profit. Either you can calculate another way also. First you have to calculate contribution per unit. So, to calculate that contribution per unit, 15 rupees of selling price unit minus 10 rupees of the variable cost per unit. So, difference price, that is 5 rupees, that is contribution per unit. That 5 rupees contribution per unit into number of units whatever we produced, that is nothing but a 1,50,000. 1,50,000 units into 5 rupees, you will get the same amount, that is contribution. After calculation of that contribution 7,50,000, you can deduct whatever the amount they given, fixed cost amount which is given in directly in the problem, you can deduct that 5 lakhs, you will get the 2,50,000 profit. So, this is the method to calculation. Next one is the profit volume ratio. So, profit volume ratio means what? This is the relationship between the contribution and sales. In sales, whatever contribution proportionate is there, that is we are going to show as the profit volume ratio. For example, contribution is 40 rupees, sales are 100 rupees. So, 40% contribution is nothing but a profit volume ratio. Contribution proportionate is 40% in the total sales ratio. These formulas which we are going to use to calculate profit volume ratio, I will explain one by one. PV ratio, to calculate that PV ratio, contribution by sales into 100, and also we can calculate with the help of that contribution. Contribution is nothing but a fixed cost plus profit. So, fixed cost plus profit divided by sales into 100. So, individual component, and one more there are one more method also there to calculate the PV ratio, change in profit and change in sales, that is also will give the results of PV ratio. So, when we are going to use this formula, if they will give the 2 years data, 2 years sales and 2 years profit, we are going to use this formula to calculate the profit volume ratio. And one more method also there, that is change in contribution divided by change in profit. So, these all the methods, these all the situations based on our data we are going to calculate the profit volume ratio. So, this profit volume ratio talks about the relationship between the sales and contribution. It is nothing but a sales and fixed cost plus profit relationship. We are going to talk about the profit volume ratio. Next one is the break even point. Break even point means what? The level of sales volume at which is there neither no profit or loss. So, here the revenues are equals to the our costs. So, this point talks about the coverage of fixed cost, and also this point we are not going to receive any profit and we are not going to face the any loss. So, that is called as a break even point. So, this level of activity there is a neither profit or nor loss. When we cross this point we get the profits. When we are not able to cross this point we are going to face the losses. So, this point simply we can say that our revenues are equals to the our costs. We are in this situation we are not going to get the we are not going to receive the any profit or any loss. Simply the cost whatever amount we spent, the cost only we are going to recover. We are not going to recover the any surplus more than the cost. So, to calculation of break even point we have using these formulas. So, to calculation of break even point, fixed cost divided by PV ratio. So, with the when the PV first to calculate the break even sales we need to calculate the fixed cost and we need to calculate the PV ratio. PV ratio is nothing but a profit value ratio, and this break even point, this BEP analysis we are going to use for the estimation sales also and estimated profit also we are going to use. And also this break even analysis required to contribution, new contribution per unit, that is nothing but a contribution is equal to sales into PV ratio and variable cost is equal to sales into 1 minus PV ratio. So, simply this break even analysis we are going to use to calculate the break even sales and to calculate the estimated sales and estimated profit. So, all the situations we are going to use this break even analysis. For example, there is a question, the following data is given, fixed expenses are 1 lakh and variable expenses 10 per unit and selling price is the 15 per unit, indicate the number of units manufactured sold. To break even from this data we have to calculate, that is break even analysis, and to earn the profit 10,000, what is the our number of units, how many units we need to sell, that we have to calculate. Here first they given selling price per unit and variable cost per unit. So, when they given selling price per unit and variable cost per unit, we have to calculate the contribution per unit. Here contribution per unit is selling price per unit minus variable expenses per unit. So, 15 rupees minus 10 rupees, that is 5 rupees is the contribution per unit. So, that contribution per unit here we are going to calculate simply. First you can calculate, after calculation of the contribution per unit we have to calculate, that is profit. So, here first we need to take individual variable wise. Variable cost is 10 rupees per unit, selling price is 15 per unit. Here contribution is equal to selling price minus marginal costing. So, that is nothing but a 5 rupees. 5 rupees into 1,50,000 units. So, that is 7,50,000. So, here simply we can say that to 7,50,000 minus that remaining 5 lakhs fixed cost whatever is there we are going to deduct it. So, that is 2,50,000, you will get that. Here I will show that contribution is equal to selling minus variable cost 15 rupees minus 10 rupees, that is 5 rupees. Here break even, to calculate the break even point fixed cost divided by contribution per unit. So, in this case they given per unit. So, we can calculate number of units of the break even point. So, 1 lakh divided by 5 rupees per contribution per unit, that is nothing but a 20,000 units we need to sell. When you sold the 20,000 units, you are going to cover the break even point. So, 20,000 units, that selling price also we can calculate. Selling price is equal to 15 rupees per unit and number of units are 20,000. So, 20,000 into 15 rupees, almost 3 lakhs rupees is the break even point. When you cross the 3 lakhs rupees, you will get the profit. If you mention the below 3 lakhs, you are going to face the loss only. And to earn the profit of 10,000 rupees. So, now to earn the 10,000 rupees profit, how many units we need to sell? What is the number of units we have to sell? So, to sell that, there is a formula: fixed cost plus desired profit divided by contribution per unit. So, here already fixed cost 1 lakh is there, our desired profit how much? 10,000 rupees. So, total 1 lakh 10,000 is the our total contribution. So, contribution divided by contribution per unit, that is 5 rupees. So, total 22,000 you have to sell. To earning of that 10,000 rupees of money, you have to sell 22,000 rupees. So, this is the calculation of desired profit. And margin of safety. What is the meaning of margin of safety? Why we are going to use? So, margin of safety is the difference between actual sales minus break even sales. Simply we can say that above the break even sales is called as a margin of safety. So, margin of safety is that sales or output which is the above the break even point. It is that sales which we give the profit after meeting the fixed cost. So, that is called as a margin of safety. So, to calculate the margin of safety, we are going to use the two formulas, that is actual sales minus break even sales, and or next one more formula also we can use, the profit divided by the PV ratio. So, these two formulas can use to calculation of margin of safety. So, here one example is there, one problem. From the following details, find out the profit volume ratio, break even point and margin of safety. Sales they given 1 lakh, variable cost they given 60,000 and fixed cost they given 20,000. First we have to calculate the profit volume ratio. To calculation of profit volume ratio, what we required? Contribution we required. Contribution divided by sales into 100, that is called as a profit volume ratio. Here profit volume ratio, to calculation of the profit volume ratio, we have to calculate the contribution. Contribution, how can we calculate? Sales minus variable cost. Sales already they given 1 lakh and variable cost also they given 60,000. So, 1 lakh minus 60,000, 40,000 is the contribution. So, 40,000 divided by 1 lakh into 100, that is 40% is the PV ratio. So, after calculation of that PV ratio, here we have one more question, that is break even point. So, break even point formula is what? Fixed cost divided by PV ratio. Already PV ratio we calculated, that is 40%, already fixed cost they given 20,000. So, 20,000 divided by 40 divided by 0.40, that is nothing but a 40%. So, that break even sales is equal to nothing but a 50,000 is the break even sales. So, after break even sales calculation, they are asking one more question, that is margin of safety. What is the margin of safety? Already previous I have told that the difference between actual sales minus break even sales. So, break even sales already we calculated that 50,000. Actual sales in the problem itself they given, that is 1 lakh. 1 lakh minus 50,000, remaining 50,000 is the margin of safety. So, after up to 50,000 we are going to cover the break even sales, above 50,000 our margin of sales. So, that is the explanation of the margin of safety. Marginal application of marginal costing. It is going to apply in price decision, profit planning, make or buy decision, and at the time of shutdown or continues the decision, shutdown or continue decision, product mix. So, these situations we are going to use. So, product or sale mix decision. So, product or sale mix decision means what? Choosing a optimal product mix to maximize the contribution or profit. So, when we are going to produce more than one product or two more products, so we have to use the marginal costing technique as I said. So, whichever the products are giving the more contribution, that product we are going to be mix and we are going to continue the production and prioritize the products with the higher contribution per unit. So, for example, product A gives the 40 rupees, product give the 30 rupees. If the labor is limited, product we are going to produce the A product only, because labor cost is same, but here product A give the 40 rupees and product B give the 30 rupees only. So, higher contribution from A side, so that we are going to produce the A product only. And this marginal costing technique also we are going to use the closing down a plant or product. So, whether the plant we want to continue or whether we want to produce that particular product or not. Based on the to know the information we are going to estimate the with the help of marginal costing only. The management under certain circumstances might feel that plant shutdown, that is closing down the business, is better, or that operations at the loss, but not always. When the plant is not able to recover the fixed cost at least, and whether they want to continue or not. So, what is the profitability position of the plant? What is the cost of that plant? What is the cost of the plant we are going to take? So, whether we want to shut down or continue that, with the help of that marginal costing we are going to use that. At the same time, we are going to consider the contribution margin before the shutdown, and what is the if we shut down that particular plant, what is the contribution? If we are continuing that plant, what is the contribution? So, with the help of that contribution we are going to take the decision. If your product covers some fixed cost, closing may be increase the overall cost also. So, in this situation also we are going to take the decision. So, this type of decisions may be either temporary suspension of the production or permanent closing down of the production. What is the meaning of temporary suspension of the production? So, temporary suspension of the production, this is the activity is a shorter measure, and the objective is usually stop the operations trade and temporary basis only. In decision to close the down temporarily, and contribution should be compared with the fixed cost which are incurred when the plant is shut down or committed to the fixed cost. Simply we can say that this is temporary suspension. If we shut down the plant, what is the contribution, and if we continue the plant, what is the contribution per particular short term period only we are going to estimate. And next one is the permanent closing down or production. So, here we are going to stop, we are going to shut down permanent basis only, we are going to shut down the plant permanently, the production of the product also permanently. The permanent shutdown does is drastic step and should be taken only when the business does not need any earn of the sufficient return to cover the risk involved. In other words, in the long term selling price must be not covered the total cost, but should be also give the reasonable return for the capital employed. So, this is the second situation. And making or buying decision. Simply in this situation we are going to compare the cost saving and outside cost. What is the meaning of cost saving? What is the meaning of outside source? So, here make or buy decision purpose. First we have to know what is the price available that particular product or component in outside market, and internally we are going to compare the internal cost. when you are calculating that internal cost, we are going to ignore the fixed cost and we are going to consider only variable costs. So, variable cost, how much it is incurred? If the variable cost is higher than the outside cost, simply we can compare the cost of variable cost if you make the product how much, and if you purchase the product outside what is the cost. So, that we are going to cover. So, here the making cost is more than the outside cost if we are going to purchase outside only, and if the making cost is less than the outside cost, we are going to make only. So, here simply variable cost is the main factor to whether make or buy decision. If the marginal cost is lower than the price demanded by the outside, the supplier component part should be manufactured in the factory itself only, because our variable cost is less, we have to purchase. And when the cost is more than the outside cost, we have to purchase, we have to order outside only. If the quality is the same, buying is the better, and fixed cost is irrelevant for the make or buy decision. Here we are going to consider only variable cost. Okay. Example, make cost is the 500 per unit and buy cost is the 400 per unit. So, better to buy outside only. And profit planning or level of activity planning. See, this profit planning and level of activity, we are going to consider marginal cost only. So, what is the level of output to get the maximum profit, and where we have to close down the activity. So, that all are, it is simply we can say that we are desired profit also we are going to calculate. So, this is the profit planning and level of activity. And also marginal costing, we are going to use selection of the suitable method of the production and application of the differential costing methods. So, this all are we are going to use. And now, I want to conclude this marginal costing. So, this marginal costing is the very important technique for the decision making purpose to give the best level of output and maximum profit of the production, and also it is very important for the business in the decision making purpose, and to estimate the future trends and to estimate the forecast, to estimate the profit for the future, the forecasting of the cost and segregation of the classification of the cost, variable cost or fixed cost, we are going to use this marginal costing technique. So, this is the marginal costing. Thank you.